Hello and welcome. PEAI is pleased to present the PEAI Waterfall Model Template version 1.1. Our waterfall models follow the financial modeling best practice principles. They calculate the outcome dynamically, are tested under a range of assumptions using a combination of testing approaches, include clear and concise assumptions, facilitate a clear link between the main waterfall calculation and the LPA waterfall provisions. They provide a detailed and accurate calculation of the main variables, preferred return, catch-up, etc., and link them to the main waterfall calculation. They can be linked to your specialist private equity platform, such as Investor and eFront, for maximum automation. They'll also be protected from accidental errors with the inbuilt checks. So let me start by taking you through this wonderful model we have here. So the first page, we'll look at the content. So this just gives the user everything that's within the model, just broken down to subsections, information checks, inputs, the waterfall, that limits partner levels, the calculation, everything's dynamically linked, so hyperlinks will take you to the respective work page. Next we have the user guides, and the model is user-friendly and easy to navigate. The user guide provides the user with a step-by-step guidance on how to use the model, set up your new fund or update the model periodically. It helps you ensure continuity by allowing anyone to just pick up the model and start using it straight away without lengthy handovers. It also helps you minimize errors or misuse the model. Next we have the navigation diagram. So this is our blueprint effectively for how everything is connected, it comes together. So the key down here illustrates what each of the areas are. So we have our inputs, our pro formas, calculation worksheets, and finally our outputs. So up here we'll have our 3 input sheets. We'll talk about these soon, and these are all linked to respective worksheets. We have our various performers depending on how we input the data into the model. Preferred return as an interest calculation. Also we have our IR by investment fund calculations. Then we have our waterfall calculations by fund, investor level, and the realized carry calculation date. And these all feed into the dashboard summary, which we'll get to soon enough. So if we jump into the dashboard, actually to show you exactly what the end product looks like. As you can see here, we have the various metrics and outputs that the model's been calculating in this format. This is the off-the-shelf dashboard version. We're able to customize this to the client's needs, so we can add more blocks or cells, or we can remove anything here. It's completely up to the client and what they require. Everything can be controlled from a single point, which is the dashboard. And we have over here, we have the calculation date. This can either be entered manually. For this example, we've done a manual ability to manually update it. This can also be done via a drop-down if you have fixed periods on which you calculate the carried interest. If we move to the next box, this is a drop-down. So in this particular example or demo we've got 10 investors, 2 different classes, A and B, limited partners, LP, and as a fund total. So we can select any of them and the respective results will show on the dashboard. So what are we seeing come through here? So this would be the cumulative contributions. and bear in mind this is at this particular date, 15th of October 2015, and investor number 7. So cumulative contributions to that particular date for that particular investor is 34 million. Cumulative distributions is 46 million. And the net asset value of the unrealized investments is 22 million. Next, we have the actual net IR and exit net IR, along with the commitment from that particular investor and contributions returned to that investor once the deals have materialized. Over here we have the fund carried interest by distribution. And in these two boxes we have the fund inception to date accrued total carried interest, and the similarly but the realized carried interest component only, 17 million. To the right we have some standard metrics for performance metrics for the carried interests and some of the distributions in paid in capital, total value to paid in capital. These will obviously update per depending on what investor or fund or class we have. And then down below we have the fund information, so just talking about the arrangement used, type of calculation, so assumptions inbuilt into the carried interest calculation. Great, so next we'll move on to the error and validation check. So as well as navigating along here, we can also right click this particular area, and that gives us all the various worksheets to go to. It's up to the user. This is my preferred method. I like to use this as it's quite easy to navigate between worksheets, particularly when there's quite a few of them. So if we go to the error and validation checks, here you can see we have a number of standard and customizable error and validation checks to ensure the robustness of the model. We use conditional formatting just over here to make all errors and validation checks that don't pass our test stand out. So you've got that reassurance that the model is working correctly, whether it's user input error or model input data error or the like. This captures over here. So these are the ones we've used for the demo, and these cover the main reconciliations or checks that we'd expect with the particular workings we've done. So these are a bit of an idea of where they are. So the worksheet that we're checking, a description of the particular check, and where to find them. So let's take one of these as an example. This one compares the carried interests at fund level compared to the aggregated investor level. So if we were to break one of the data cells in the waterfall calculation, then we should see a bit of an error here. So let's just give that a go. So if I go to LP level, now then, let's remove investor 8's distribution. Let's see what that does. And by removing this, we know that, first of all, the accumulated value will not equal. So already we can see that this one's out, so you can say this column's not quite right. So all of a sudden, we now know that the amounts to distribute won't be the same as the total allocated at each stage, and also the aggregated amounts for all of these will be different to the fund total because investor 8's now removed it. So let's go back to our calculations, error and validation check, sorry. Yep, and there we go. We can clearly see that it's not flowed all the way through, so that was the worksheet that we were just on, and also that the fund level is not equal to the cumulative investor level. So if I just go back on that, there we go, and go back to our error validation check. So there we go, back to normal, great. So this gives you that reassurance that the model is working correctly. And again, if there's anything specific, we can always add more to this. I wouldn't recommend taking anything away. Great, so the next worksheet we have is the Waterfall Provisions LPA excerpt. So here we've just provided the LPA to provide some of the references and definitions in the clauses. And you can see later on when we look at the waterfall calculations, they refer to 6.1, 6.2, 6.3, and so it's clear. Anybody reviewing this can see exactly where we've derived our numbers and assumptions from. So next sheet would be our assumptions. We've included clear and concise assumptions, particularly useful when the LPA is not explicit on certain areas of the calculation and the modeler needs to make assumptions. After all, as in any financial model, you change the assumptions, the outcome automatically changes. This is extremely important to have for potential reviewers or the stakeholders such as auditors, investors, etc., who potentially be interested in the model. Now then, if I go back to our navigation diagram, we've been through all the errors and checks and the LPA and assumptions and navigation diagrams of content. So let's start getting into the model. So let's start at the start with the inputs. So we've got 3 inputs here. We've got static data, scenarios, and valuations. So let's start with our static data. Now, as you can see here, for this particular demo, we've shown you we've got 10 investors and we've got a CIP, carried interest partner, and we've got the total LPs, limited partnerships, and then a consolidator including the CIP. We've also got 2 classes, as we talked about earlier when we looked at the drop down in the dashboard. So the first class was they put their commitment in on the 1st of the 1st, 2006, and we've got the respective percentage by commitment at that closing date here. And then there was a second commitment closing date at 1st of the 1st, 2007, where we introduced Class B limited partners, and now we have our percentage showing the commitment by that particular closing date for all our 10 investors, and then summarised. Obviously we've got 100% for the fund, 0 for CIP, and then 50-50 for Class A and B respectively. If I open up this little fella here, so we've also got, excuse me, we've also got here some of the other static data, so it's important to call out. So we've got our excused investors, opt in and opt out. So potentially if we've got, I don't know, five deals, not every investor will opt into every investment. So this is what referring to that. In this particular demo, all investors opt into all investments. So, and as we've got here, we have our 10 investors in our fund. What else are there? Closing dates, we've talked about these earlier. So we've got our event type, capital call, distribution, cash events. So they're just easy to reference. Obviously the date, allocation rules. So there's a couple here: by commitment and closing date, by remaining commitment as a certain date, by sharing percentage for a certain deal. Next we have the transaction type. just to note that we use the Institutional Limited Partners Association, ILPA transaction types, but we can map them to whatever transaction types you, the client, are using. So you can see here, we've listed them all here. The deals, so that would be the initial call for the deal, and then various deals that we have set up, we reference them by letter. Deal status, whether they've been realised, and capital and any gain returned back to the investors and the fund. Partially realised and unrealised deals. Valuation dates, we'll talk more about this, which relates to valuing any unrealised assets. Management fee, committed base, activity based, some of the management fees, and some of the scenarios, which we'll talk about again. So that just gives you a bit of a flavour about the static data that we can use to input into the model. So let's go back to the navigation diagram. There we go. So next input we have our scenarios, which is called scenarios, but I'll talk about scenarios more towards the end. So if we can just ignore this part and this part. Now then, so this gives us, this is our other input. So we've decided the percentage split depending on the commitment of each investor and class and fund, etc. So now we get to the details of each particular investment. So we refer to our investments as A, B, all the way down to G. We have our various transaction types, so call investment, the distributions from that particular investment, and when we realised or sold the asset, we have over here we have the return capital and cash and realised gain for that particular investment. So this will, as you can see here, not all of the investments will have distribution or dividends. The various dates of realised date, depending on the calculation date, may have not been realised when we calculate them. So that would be our other input. Our third input would be our valuations. So the valuation worksheet, basically this is used to help come up with a valuation for any unrealised deals. So as you can see, the valuation date here, 31/12/15, well, these were a start and an end date. These actually haven't been realised yet, so the model automatically recognised that and said, look, these F and G have not been realised at this particular valuation date. So what that does is it tells us that, okay, for the 31st of the 15th, we come across these two blue cells here, which are dynamically changed depending on the date, which I'll show you in a bit. We need to give a value to these particular assets at that point in time. In this instance, we've given 250 and 119 million respectively. So as you can see, compared to the initial investment, these have got a gain of 150 and 71% respectively. So if we took a step back and I changed the valuation date to, say, the year before, as you can see, the blue conditional formatting has updated these dates. So what we'll see, and what's happened is now, because it's the 12th December 14, now investment E has not been realised either. So now we have 3 unrealised, and we have to give a value for that particular investment as well. So the conditional format lets the user know, saying we actually need values here for these particular investments in order to do the realised and unrealised calculation workings on the waterfall calculation. Again, with this one, with the initial call investment was 80 million, and we've given the investment a value at that particular date of 50 million. You can see it's 38% unrealised loss at the moment. So, and effectively, all the rest of the calculations, they break that down by investor and give a breakdown between the realised and unrealised gains, and by class, and the total fund obviously here as well. So. Another thing is the calculation date is derived from the dashboard, and the valuation date. So at the moment we've got a drop down for particular dates, but this can be linked to your calculation date, so it all updates dynamically. So if you do report periodically, then you could potentially select Q118 for the first quarter in 2018. And then that would the valuation date would go to the respective date for that particular valuation. So it's all automatically. Then you just have to manually input the valuations for the date it's asking you here. Now moving on. So we've got our three inputs. We've got our static data, scenarios, and valuation. So if we move on to, if we go back to the diagram first, we can see that for this input, the cash flow schedule or performer, whatever you want to call it. So we can see that the static data scenarios come into here, and it gives us effectively an overview of the static data, and then as you can see the A to G and all the particular transaction dates. You can see the transaction type here. Distribution and capital call numbers, and does all our workings here. So this is really important. It gives an overview in chronological order of each of the transactions by investor. So in order to produce the calculations and some of the workings, we put this data into a flat file, what we call a flat file. So it's effectively taking the matrix and bringing it down to single line items. And from here we can use this data then to populate the waterfalls. The third one we have is similar to the cash flow schedule, input 3 deal info. So this really gives the next level of detail around all the transactions. So similar to the one that we just looked at, the cash flow schedule with the filter on it. But this schedule is extremely important for deal by deal hybrid carried interest arrangements, when a more granular deal level information is required to calculate the return of the contributions for realised investments, written down or written off investments, and prorate a share of the drawdowns from management fees and expenses. So we've got the original costs here, fair value basis, percentage of realised for period day, inception to date percentage realised, realised cost for period date, and total inception to date realised cost. So and this is where our information from the valuations comes into play. So if I go back to our navigation diagram, we can see here we have the information from the first schedule flows into the flat file, and then flows into that main detail schedule, and this is where the valuations come into that schedule. So this is very important for the next level of detail if that's required by the client. And probably something else to note as well. So as you saw from the original one, potentially some clients prefer, their inputs into this model are this view. They could be the flat file, it could be this view. So there could be an actual trial balance produced, which again we would convert into this flat file, which we use for the working. So all inputs can be accommodated and can be customized for the model. so there's no particular issue there, and can be synced to some of the private equity software that we mentioned earlier at the beginning of the demo. So before we go to the actual waterfall diagrams, I just wanted to take you to some of the calculations and how the interest is calculated. So if we jump on to this, so here you can see all the cash flows and the dates. This is all linked to our initial inputs, the dates and the dollars, and these are the schedules. So each investor, investor 1 here, scroll over, investor 2 has their own schedule, hurdle rate of 8%, and this calculates on daily balances of unreturned net contributions. The client has the option to choose what approach to preferred return to take. This is the preferred return calculated as an interest. We'll get to the calculated as an IRS in a second. So whether as an interest or as an IR, there's the ability to choose the hurdle rate, frequency, and date of compounding, whether to aggregate cash flows or segregate them. The calculation can be customized to specific client waterfall provisions interpretation. So this is just how we've set it up for this particular demo. So we can see preferred compounding, yes, and it's every 12 months. And this basically feeds into the waterfall calculation. But again, all this can be customized depending on what the client is after. So the other method to calculating the preferred return is through as an IR. So if we just apologies, if we scroll over preferred IR, say this is, so if you or your lawyers or LPA give preference to the preferred return to be calculated as an IR, then that's the approach you should choose for your waterfall model. However, you may incorporate both. So sometimes with certain cash flow patterns, the difference between the two approaches may widely vary, and it could be in the range of millions. That's why it's very important to choose the right one for you. Now then, let's go to the more the interesting stuff. So as I've mentioned, so if we go back to the navigation diagram, so we've talked about the inputs, the performance, and some of the interest calculations. Now then, all of these are used to calculate the carried interests in the waterfall calculation. So let's jump into the more straightforward one, which should be at the fund level. So what do we have here? We'll start off with some of the assumptions. I think we've mentioned these in the assumptions page, but if the client wanted to print this off, we've got the all the details, company, what we're doing, what particular arrangement it is, and all the summary and assumptions used here, so it's clear if whoever's viewing this can see how it's being calculated. We've got the calculation dates, so the date at the when the calculation is being undertaken for the waterfall, and then also the valuation date. This valuation date relates to the valuation of the net assets, unrealised net assets, and their valuation. So if we just jump down to this schedule first, and I'll explain how it all flows together. So the commitments, so the fund commitment at $1 billion, at that particular date, we have call investments of 500 mil, management fees since that commitment of 62 mil, with a total of contributions of 562. Inception to date distributions by transaction type, which we've talked about earlier. So we've talked about dividends, return of capital, and realised gain. So here we go to total 765, and the net contributions to distributions, basically the sum of these two, gives us 203. And then for the waterfall calculation purposes, we need to look at our cash bucket. So the cash bucket cumulative distribution is 765, which we calculated down here is 765. And on top, so this is realised. This is realised at this particular date. So what we also need to add in is the unrealised portion, which is the valuation we provided earlier based on this particular valuation date. So this gives us a total cash bucket of 1.2 billion. Now we have to distribute that between limited partners and carried interest partners through this waterfall carried interest accrued calculation. So first thing to note is, as I talked about in the beginning when we looked at the LPA, there was references to each particular item, so the definitions are clear and it's clear what we're referring to. So the first step in the calculation, so it goes across, so you have your opening balance, closing balance, opening, closing, and it flows down in each hurdle. So the first hurdle we have is we have our 1.2 billion. First step, 100% return to of the contributions returned to the limited partners. If you remember correctly, the CIP did not have any contributions, so it's 0. LPs has 562, so that's all returned. So that's the first step. So there's enough distributions here to do that. So what's our balance? So it's the 1.2 billion less the half a billion, which gives us around $611 million, which is carried forward to the next stage, 6.3B. And this is a preferred return of 8%. So the CIP carried interest partner is not entitled to any dollars until the hurdle is met, and that's one of the main principles of this model. So the calculation from the carried interests workings that we looked at earlier, we can see that the returns to the limited partners is 185, and again nothing to the CIP at this stage because it actually had no equity in, so it's 0 again. This now takes our total distributions to 426 million. So the next stage is, okay, great, there's enough in the bucket or the cash bucket for the CIP to catch up. So 0 to the LPs and 100% catch up to the CIP. So it's effectively this divided by 80 times 20. So that we've got the 80-20 split, and it's basically catching up with the split for these particular returns. So now that's 46 million, which gives it a total to date of that. Obviously 0 because it's a catch up for the LPs. Now we're left with 379, which is the final stage, 379, and that's just split between the LPs and CIP, 80 and 20 respectively. And we've got a split here, which gives a total of 379, which is what we had carrot coming in, meaning we've got $0 left. So as you can see here, these are the two we're looking at for the carried interest calculation. The LPs now have, from our original 1.173 billion, they have roughly around $1 billion, and the carried interest partners have 122 million, an effective split of 90 to 10%. Over here we have a quick reconciliation, and as you can see from this particular, it's 100% catch up, which is correct. CIP 100%. Second of all, the last stage is the 80-20 split, great, and the 80-20 split here. So this tells us that the calculations coming through are actually working correctly. Now then, one of the things to note is, given the fact that this is later in the course of the investments of the fund or the strategy of the fund, so we're fairly late on, and obviously there's a few distributions, and most of the deals are vested and been returned to the investors. So what you might find at earlier stages, if there's not enough in the cash bucket distributions, then potentially you may just have enough to cover the return contributions, which means the CIP would receive nothing. And again, the hurdle rate may not be achieved, so any net distributions will go to the LP, and the CIP will receive nothing again. So it's only when we've passed these two hurdles, return of contributions and an 8% preferred return, only then does the CIP get to catch up. And once it's caught up, then the balance of that is split 80-20. So as I said, this is later on in the strategy of this particular investment fund. So it's a little bit different. And I'll show you an example when we look at the distribution waterfall and how that changes. So next one would be just the realised component. So it's similar to the one we've just looked at, but this is the realised carried interest calculation. So it excludes the unrealised component. Similar again to how it comes through. And as you can see here, this is what I was talking about earlier. So because we're not adding on the net asset value or the unrealised component of those particular assets that haven't really been realised yet, you can see here the cash bucket, there's the return of contributions, same as per the prior work in the 562, which gives us a balance of 203. The catch-up is, the hurdle is 185, which is great, which gives us a balance of only 17 million. Now then, the catch-up, the full catch-up hasn't obviously been achieved here. So at this point, we can see the effective split is now 98 to 2%. So as those underlying assets that haven't been realised are realised, then this number will increase, and then hopefully for the CIP, there'll be distributions left to get further another 80-20 split. So as you can see here, not enough coming through from just the realised distributions, which means the CIP is effectively only getting 2% of that total cash bucket. Similarly, this may look quite complicated, but this is effectively the same as the other two, but broken down by investor. Slightly different pro forma, but the same thing happening. So you've got your before and after rather than on the slides, and you can see each stage on how much the LP and CIP are receiving. Over here is the cumulative. You can see similar as well, commitments by investor, and then the call and the distribution component, which then flows into the cash bucket, 76, and the net asset value per its investor 2. So each investor's total bucket for distribution is as per here, again based on the same calculation date and valuation date. And we have it by class and total LP and the CIP and general partner. This isn't actually used in this particular demo, so we'll ignore that. This one just gives the option to if we wanted to kind of show the waterfall calculation for a particular investor, this is controlled by the dashboard. So as you recall, we had investor 7 at the dashboard. We can actually change this, and we can PDF maybe the client would like to see what carried interest is being paid at a particular date and valuation date and time. So this just gives the user, the client, the option to kind of customize the reports if that's what they wish to do. And finally, these two are exactly the same, but all they're doing is calculating on the distribution. So this one's distribution 11. So all this is doing is calculating the prior one, so distribution 10. And this is all it's doing because it calculates the inception to date, so basically in a cumulative, by calculating the current cumulative and the prior distribution cumulative, we can find out what each distribution is actually being is the carried interest component. So in this particular example, the distribution 11 will be the $2 million in the current distribution is all going to go to the CIP. So we can these can be used to forecast and budget and do those types of calculations. So essentially the same thing, but instead of by date, it uses the by distribution. And as you can see here, there's 14 distributions, and we can pick and choose which one we want. If we go to the last one, for example, just take a second to think. So it's done those calculations now. So what this is saying, and this effective rate is on the current distribution, not on the total. So because it's gone through each of the buckets, and the last bucket it's 150 million. We're in the last bucket, and it's split it between the LP and the CIP 80-20. So you can see for that distribution 18. The split of the 150 is 120 and 30. So this is exactly what it's showing. And yeah, so look, those are all the waterfalls, and there's various levels. So at fund level, so we've got the accrued carried interest, we've got the realized carried interest. We've got it at LP level, so we've got it by single LP level, by distribution. So the client's got several options to use and to report on, depending on what the requirements are. So and a summary here between the for the accrued carried interest and realized carried interest calculations as a summary. Which we've already looked at, just summarised it on one page. So I did promise that I would go back and show you the scenarios. So the scenarios is not included in the basic version of the off-the-shelf model. So, but the client can request this, and this is useful for. Let me just unhide this. This is useful for determining potential. So, if a client wanted a budget, or have a look at how different scenarios of investments might play out, what this can do, you can add in the various values here. So, for example, for this one, it's the same as we've changed the management fee, and we've also removed the distribution. So what we can do is we can select in the static data, we can select whether we want the original one we're working with, or maybe a scenario 1, which might be an optimistic or a pessimistic scenario, or a midpoint. So we can change all the numbers, and then they'll automatically run through the model and give you an updated carried interest calculation based on high, low, medium, for example, or potentially if a client wants to know potentially what their carried interests may be, then we can use this to kind of play around with some of the scenarios. So this is, like I said before, an added. It doesn't come with the off-the-shelf version, but this can be added to your particular model, and we found it very useful for managing your assumptions and those types of things. So if I skip to this one, so this is where we can select the various scenarios. So we go scenario 1, scenario 2. And then this will flow through all the numbers and the respective waterfall calculations for the carried interest. Now everything's everything. So we've been through the inputs, the performers, the preferred return interest calculations, the IR buy-in first. So this is just an output. One thing to note, the IR is calculated, so variable dates, so it doesn't have to be specific locked-in periods. So distributions and call can be whatever date you may like, and it will calculate the respective IR. We've got all the waterfall calculations, and we've got the three main ones here, but there we've obviously got more than that, which all come back again to what we said before, the dashboard, and this is where everything gets summarized. Just to remind you, we can add things in, take things away. That's no problem at all. We can add graphics if someone prefers to look at that, or data tables, etc. We can even have our scenarios where we look at the best case, worst case scenarios in here. The limits are there's no limitations to this, and we're fairly flexible with what we can do. So with that, I bid you farewell and thanks for listening. I hope this was a useful demo, and yeah, we look forward to hearing from you. If you've got any questions, the email address is down here, info@peaccountinginsights.com. Please do get in touch, and yeah, we'll look forward to hearing from you.